Hi everyone, welcome to Financial Executive Club. I'm Margery Wong. Are you ready to invest smarter? So this is the question for you to think about today. And we are so glad today we can invite Gregory Wong, CEO and co-founder of Endowus with us. So Greg, would you like to introduce yourself and tell us more about Endowus?
Yes, absolutely. Look, it's great to be here with you guys today. Endowus was founded on a very clear mission to bring endowment investing to all of us. And the reason why we care so much about endowment investing is because it is the way the most sophisticated investors in the world manage wealth. If you're a charitable foundation, if you're a school, if you're a sovereign wealth fund, this is how you manage money. Now, I was really confused by this when I started my career at UBS in the investment bank and realized that the way I was managing my own money, the way my parents were managing their money, the way my friends talked about managing money was completely different from what our clients were doing. And we're talking about, sovereign wealth funds with hundreds of billions, if not trillions of dollars investing in, and my specialty at the time was actually in private markets. So this is weird. Why? Why is there such a disconnect? We went into it and we understood that there were some systematic reasons for this. One is advice. And advice, when it comes to individuals, we realized, was often conflicted. It was conflicted because of the business models that were being used to deliver that advice. So, for example, if I have 3 funds that I might want to sell you as a distributor, I would probably choose the fund that paid me the highest commission. So this is called a trailer fee. So for people in the industry, they know about the trailer fee. Surprisingly, most of the general public and actually a lot of clients of private banks, retail banks, et cetera, even online platforms, they've never heard of the trailer fee. Number 2, a lot of the incumbents in the industry make money on transactions. So immediately we've introduced an incentive to generate churn and an incentive to sell high commission products. And I think that was kind of the foundation of why we think advice, for the most part, has not been aligned with the end client. So as a result, if we remove those things, we can actually focus on delivering evidence-based advice that is personalized and tailored to your needs and goals. Very similar to the way endowments do it. So endowments would call this liabilities-driven asset allocation, and we'll talk more about that later on in this episode. So that's advice. And then layering on top of that advice, you need access to the right products, solutions, and portfolios to express in a globally best-in-class way the asset allocation to achieve those specific goals you have. Okay, so that's advice and institutional quality access. And then all of that coupled with that foundational piece of low, fair, and transparent fees. So Endowus is very unique in that we charge the client directly in AUM or AUA, assets under advisory based fee or platform fee. And it's transparent. It's transparent on our website. We're not negotiating special deals with everybody and saying, you're a smarter client, so we'll give you a lower fee, and you don't know what you're doing, so we're going to give you a higher fee. We don't do any of that. We have no sales charges or redemption charges because we don't want to be in a position that jeopardizes our independence to deliver that evidence-based advice. So if we were earning those fees, again, we would be incentivized to maybe create some churn activity. And if we receive any trailer commissions from fund managers, we return 100% of that to our client as cash back in your account. You can reinvest that, you can take it out of the account, you can do whatever you want with it. We're giving back millions and millions actually today in cash back to our clients every year. Also, for the most part, we work with fund managers, and we work with about 100 fund managers today across all asset classes, from cash management, fixed income, equities, private markets, and hedge funds. across the various strategies. So from pure beta, low cost beta, so indexing, quant beta, all the way to high cost, super exclusive alpha. We can then layer and create portfolios that match your liabilities to achieve your needs and goals. That's really how we achieve endowment investing for all of us, which is what we're after.
This is really interesting, Greg. So when you talked about the endowment investing, so a lot of people may think about like really huge amounts of money, $1 million portfolio. So when it comes to the individual, they may not have that huge of amount of money, right? How you make that happen? Because it's just too good to be true. So to our audience, they may have a question mark. How you can do that?
I think we are actually at a point in the evolution of the way people manage money and the way fund managers also deliver their products, which is making this possible. First of all, technology helps a lot. You know, for us to deliver these personalized self-governing portfolios to thousands, hundreds of thousands of people today across Hong Kong and Singapore, it'd be impossible to do without technology unless we had tons and tons of humans. Now, humans also have their own, biases and things. We have human advisors, but their sole purpose, and they don't take market views or say, hey, I think you should buy more China now. I think you should buy this fund. I think you should buy that fund. Their sole purpose as an advisor is to help you match our portfolios and our solutions to your goals and try and optimize that, as best as possible. On the other hand, fund managers are looking at the way in which their products are distributed. For a long time, it was a commission game. So if I pay more commission, my fund will sell. For the most part, that is still the game. But I think for the really best of the best fund managers, they understand that they want their funds to be sold in a way that suits the client, because in that scenario, the client will also stay invested in that fund and reap the benefits, the true benefits of that fund. Another point is, there are too many fee layers today. Because if there's a sales charge and then you're paying for a retail share class, which is higher fee at the management fee level so that it can pay back a trailer commission to the distributor, then all the fees are inflated. And what that actually means is the end client has a less good experience of that fund. I could be any fund, right? Because the fees go straight to the bottom line. So if there is a lower cost, more aligned way of distributing high quality funds, fund managers are totally on board with that. And as a result, I think, Endowus has managed to create a lot of exclusive inventory of funds, exclusive portfolios, and things that you could not really recreate anywhere else. And I think what really excites us is that we're doing it properly. We're doing it in a conflict-free way, and our clients are reaping that benefit. So this is a self-fulfilling prophecy. It will just keep on compounding on itself, as we've seen for the last half a decade.
You talk about some portfolio that already created and is quite hard for anyone to replicate, right? So what do you see are really a balanced portfolio? Because you mentioned about hedge, you mentioned about high-grade equity bonds. So to you, what is a well-balanced portfolio look like?
So we have a very, unlike I think most distributors, we don't say, okay, let's pretend this is a portfolio, this O here. We don't say, okay, this is the ideal portfolio right now. Because what this is entirely dependent on what your own liabilities, needs, and goals are. So, we have a very good slide which shows you first how you structure your money in an evidence-based and liabilities-driven way. So you create smaller portfolios or buckets of money that achieve a core goal. So if I have a house down payment in 2 years, I would invest very differently than my retirement in 20 years. Or for my child's education, because I'm sending them overseas and it's a bit more expensive, my child's education, which starts in 8 years. So for these goals, down payment in 2 years, child's education in 8 years, retirement in 20 years, we call these core goals because they are truly your life needs. And for these core goals, we don't try to be tactical. We try and match your portfolio to the duration, liquidity, and volatility of those specific goals and try and achieve the highest expected return within those parameters. So we don't want to mix them up because, as an example, when you do get to your down payment in 2 years, you will redeem from that goal, but not affect the other goals. And that's very important. So we call that's the core goals. And then if you have satellite views you want to express, a tactical view on a particular manager or a sector or geography, you can express that as satellite positions. And again, you can size that how you want. But usually by going through this process, you actually understand how much risk you can take in the satellite positions, how much risk you can take in longer term goals. And talking about private markets in particular, I mean, depending on if you're in private credit or private equity, or private infrastructure, you can say, okay, I'm trying to generate income for whatever purpose. I help my parents out, or I help out a relative, or whatever it is. I'm paying off a mortgage. Private credit could be in that bucket, and that could start paying you supplementary income from today. But as you go longer term, and I'm like, okay, my retirement is in 10 years or 20 years, I can start to introduce illiquid securities like private equity. And that in totality will make up your overall asset allocation. And again, technology is what makes this possible. And our human advisors are just helping people understand these liabilities, ensure that they are the right size, and that they are utilizing the best of the platform, which has access to 100 managers, about 400 strategies that we have due diligenced and put onto the platform for you to access. So you have these core goals, satellite positions, and the overall portfolio. These core goals will look different for every single person, which is why, again, we don't say, okay, you should be in 40, 40, 20. Like, we don't think that is the right approach. We think we're at a stage now with the power of technology and access that we can do this on a much more personalized level.
That's good. So, Greg, very good. You talked about private credit. So it sounds to be quite trendy. I heard a lot of people talk about private credit lately. Can you share us more about the trend and also the outlook for you?
Yeah, absolutely. I think what's really important when it comes to investing in any form of credit is you understand the risk-return trade-off. When you invest in credit, diversification helps you a lot. You have very little reason to concentrate. So for example, if I have funds or even single line bonds, or even like if I'm giving out a loan, 10 people of equal quality are saying, hey, I'll pay you 10% for your money. I don't have a reason to just pick one, because the best thing that can happen is that they pay me 10%. But the worst thing that can happen is that they default. So with private credit in particular, where you're investing, if you structure your portfolio well, in a very diversified way across different sectors and across different company sizes, you are able to really get a very diversified pool of income and limit the downside risk. Because again, I could find one deal maybe that my friend shows me that's going to pay me 14%. But there's no free lunch, right? If that one deal is going to pay me 14%, then that one deal is probably slightly higher risk than the general market. And if it goes sour, I could lose all of my money. So rather than doing that, we want to work with the best managers in the world to provide our clients with an extremely diversified pool of private credit. So what we did is we created a portfolio with exposure to private credit strategies managed by Blackstone, Apollo, Oaktree, Cliffwater, Carlyle, HPS, Ares, and Blue Owl, 8 of what we consider to be best of the best managers globally. Some are focused on the mid-market, some on the mega cap, some on leverage buyout, some on distressed, etc., all trying to produce that 8 to, let's call it, 11% return. Or I like to actually think of it as a return over the risk-free rate. I'd say about after fees, maybe 400 basis points, so 4% above risk-free. So currently, I'd say about 8% or 9% after fees. And give you exposure to that at a very small bite size. So at a bite size as small as $100,000. It's not tiny, but we think it's the appropriate size for someone looking at the asset class. Because, if one of those managers has part of their portfolio run into trouble, then you have a huge amount of balancing act to express yourself to the overall asset class, rather than trying to be concentrated.
Okay, great. This sounds to me like traditionally we can only approach through the private banker. So now it's more accessible through the digital platform. How you compare between the private bank and also like this kind of digital wealth management platform like yourself?
I think it's more important, rather than the way in which you're accessing, I think it's more important that you fundamentally understand how the person or the platform serving you is making money. And you need to decide for yourself on what aligns to you. So at Endowus, we're very focused and very transparent on being conflict-free, charging you an AUM-based fee. Some people don't like that. Some people prefer if everything is embedded in the product and they don't see additional fees. We think that our model is what helps the client succeed and actually net save money, because usually, the embedded fees are higher than the fee that Endowus is charging. So whether it's digital or private bank and other digital platforms that offer funds, they're usually earning commissions as well. So they're usually selling the higher fee share class, and then they're earning commission or trailer commission from the fund manager, once they collect that management fee. Again, we think that leads to potentially an unbiased, misaligned approach, where, again, I might onboard funds that pay higher commissions rather than the best funds. So we're trying to remove negative selection bias, is what we call it in the industry. And we've created essentially a true meritocracy when it comes to fund selection and access. So ultimately, I think the individual investor needs to decide what aligns to them and how much work they want to do on it.
Yeah, I'm sure our audience know about that because most of them actually from the banking background.
Yeah.
So they probably know about what you talked about.
Yeah. So I mean, for what it's worth, most of our clients, because it is a bit intricate to understand sort of why someone would use Endowus.
Yeah.
So I think most of our clients tend to be from the finance industry, although we want to be much broader. And we actually think that it's the job of the people in the finance industry to help their communities, help their families invest better as well. Really spreading this word is a very, very important part of what we're doing.
Yeah, agree. Because like you mentioned about different kinds of, we call it lifetime event. So you might want to get married, you want to have a child, and your child will go into university later on. So I think the idea is so good because like we do have different kinds of core goal, and then we might have some side pocket, maybe different kinds of goal. Then you can set up and do your own investing.
Yeah.
Which is the past, then as I said, right, it could be like very huge. You need to have a huge funding before you can do that. It sounds like it's more like approachable right now for us.
I think it is more approachable, but approachable is not always good. A lot of things are now very approachable, but they may not be good for you. So I think being able to distill what will actually impact your life and your wealth is what all of us have to do as individuals to take care of our families.
Yeah, I agree. So maybe last question from me. You mentioned a lot about different kinds of fees, trailer fee, commission, all these things. So can you tell us more also when we choose any funds? So what should we pay attention to a fee item? There are a lot of things.
Well, I think the most important thing is probably your net return after all fees, including the Endowus fee, including the fund level fee, any wrappers that are involved and everything else. And making sure that the risk you are taking is compensated with that net return after all fees. We really focus on this at Endowus, which is why we're constantly fighting for the client to lower fees elsewhere in the system. Now, a lot of distributors may also have a fund management arm. And, if you've been a client of a lot of these distributors, maybe the first thing they do is say, hey, why don't you buy our fund of this, even if they have funds from other managers. It's because then the organization might earn a couple layers of fees. I think what's really important is that you're being served by an independent player that is open architecture, which means that you can access the best of the best across the entire spectrum. And that goes for private equity, hedge funds, etc. You would think the best hedge funds in the world charge ridiculous fees. Ridiculous, okay? They have double layer carry, what they call cost pass-through, and many other things. So the gross to net return differential is massive. And what we have to do is understand if it's still worth it after all of that and after sacrificing liquidity. So again, am I getting compensated for the risk I'm taking? Am I getting compensated for the illiquidity? So the inability to just sell my portfolio in a day. Am I being compensated for that inconvenience as well? And that's what we as investors have to assess. And that's what our client advisors and our platform helps people understand when it comes to investing.
Yeah. I see. Really good sharing, Greg, today. So do I have any announcement to our audience?
No, I mean, I think, understanding the way the system works is really important. And the need, if you are able to, as a professional investor, if you are able to access private markets, I think it's an important part of the overall portfolio for your medium term and longer term goals that we had talked about. Like when you have the time horizon, when you can sacrifice the illiquidity. We're at a stage now where most of the companies with EBITDA over 250 million are actually private in the world. So I like to say in private equity, for example, which we didn't touch on too much today, but in private equity, if you have your public market portfolio, which we have at a very low cost on Endowus, this is daily liquid, etc. If you have your public equity portfolio, private equity is really supplementing and adding to the overall diversification of that equity portfolio. Now, I personally think that we should assess volatility for what it is. So private equity volatility, it doesn't mark to market as aggressively as public equities, but you are taking company equity risk. You should consider the volatility to be similar. Okay, but you are adding an insane amount of diversification. And if you have good manager selection, you are able to generate, at least historically, a higher return. And manager selection in private markets, because information is a lot less transparent, manager selection shows persistence, especially if you are doing it at a low cost. So if you pick the best managers but are paying through your teeth in fees, that alpha is gone. So again, very, very important that you manage it at every step. And finally, I feel like a lot of people that a lot of our clients don't fully appreciate the power of compounding. And what often seems, people are very barbelled. They're in a lot of cash. And then on the other side, they're in very, very volatile things they're trying to trade. And as a result, they miss out on the power of compounding. On the trading side, sure, you can make 100% on a stock in a week. It happens every week.
Yeah.
But how much can you allocate to that to really compound wealth? And if you're able to move and organize your money so that you have these higher compounding buckets for the longer time horizon goals, that can make an enormous difference to your life. So the difference, and we're not even talking about like private equity returns, but the difference between 7% and 8% for 30 years is 245% compounded. Most people are sitting more like in 2-3% in cash and are missing out on an enormous amount of change. So we have an awesome table just showing the mathematical relationship of compounding, and like I definitely want to share that with you and the audience to see that we need to pursue higher expected returns when we can sacrifice liquidity, tolerate volatility for that specific pot of money, not for the house down payment in 2 years.
Sure. Thank you so much, Greg. Private equity or private market, private credit, all these things, all this trendy thing is a good component to your portfolio. Are you guys ready to do more investment into private market? Tell us more in the comment page. Bye-bye.